Welcome back to the Deep Dive. Today we're doing something pretty interesting. We're looking at two really different parts of the economy.
Yeah, totally different scales.
Exactly. We're going from the nitty-gritty details of one content creator making money online all the way up to these huge global trends in tech investing.
It really is the ultimate micro-macro split. So on one hand, you've got this individual creator based in Hangzhou, China. We see their actual struggles, their successes, how they optimize every single dollar.
Meticulously.
Right. And then on the other hand, we're looking at, billions of dollars moving around. The volatility, the investment plays in semiconductors, memory chips, companies like TSMC, big stuff.
And our sources today are, they're specific. We're aiming to pull out real practical knowledge from them. So the mission is kind of connecting the dots, right?
Exactly. Taking these clever logistical hacks someone needed just to get paid in China.
Like getting a pin and mailed, yeah.
And linking that right up to the huge macro stuff. Like, why are prices for supposedly obsolete tech suddenly shooting up? There's this surprising force at play.
We're talking about finding value where maybe others aren't looking.
That's it. Whether you're that creator trying to get a good return on a few $1,000s or an investor seeing how shrinking supply makes old hardware suddenly hot.
It comes down to spotting that non-obvious value, recognizing the power of what people call the long tail.
That's the common thread, the long tail effect.
Okay, so that's the theme we're chasing today. How do you find that value that others miss? Let's unpack this, starting right on the ground floor with the creator economy. Okay, so for anyone out there dreaming of, making content creation their job, the first big step is getting into the YouTube Partner Program, YPP.
Right, the rite of passage.
And our source creator, Zhao Tudu, they gave us a fantastic, really quick case study, like the exact rules and how incredibly fast they did it.
Yeah, and this is essential groundwork. You can't even start thinking about making money until you hit one of two thresholds.
What are they?
Well, the classic one, maybe the more sustainable one, is the standard requirement. You need 1,000 subscribers.
Okay.
A&D, 4,000 valid public watch hours. And that's within the last 12 months. So it rewards people actually sticking around and watching your stuff.
With retention.
Yeah.
But YouTube's always trying to compete with, TikTok and the others.
Oh, absolutely. So they threw in this other option, a shorts alternative.
How does that work?
You still need the 1,000 subscribers, that part's the same, but instead of the 4,000 watch hours, you need, get this, 10 million shorts views.
10 million, wow.
Yeah, and crammed into just 90 days.
That really shows you what YouTube's prioritizing, doesn't
Yeah.
it? It's like, forget retention.
Yeah.
Just give us eyeballs, volume.
Pretty much. 4,000 hours, that forces you to make longer stuff that people actually want to watch all the way through.
Yeah.
But 10 million shorts views, you can maybe hit that with some quick viral clips that don't build any real loyalty, Yeah.
It's probably harder psychologically to hit that 10 million number, even if short form stuff can sometimes go viral faster.
Yeah.
It just seems like a high stress, high volume game.
But what's amazing about this specific creator's story is how quickly they hit the standard YPP threshold. The watch hours won.
Right.
They launched their channel, put up the first video on December 24th, and by January 3rd, that's just 10 days later, boom, they met the requirements using the traditional long-form video metrics.
10 days is.
Yeah.
Yeah. Phenomenal. Now, the source did mention they had some existing professional influence that helped. But still, it shows if you come in with real valuable expertise, you might be able to skip that long, slow grind most creators face. People watch because the content was good. High watch time from day one.
Makes sense. But like we said, hitting YPP, that's just getting your foot in the door. The real headache, especially across borders, is the bureaucracy. Actually getting paid, ##B, navigating Google AdSense setup and verification in mainland China. So next step. You link your YouTube channel, now that it's monetized, to a Google AdSense account.
Right. AdSense is where the money actually goes.
Yeah, it's like the bank account for your channel's earnings, calculates everything, holds it till you hit the payout level. But, and this is a big but for creators in places like mainland China, the process gets tricky. Lots of specific friction points.
And the biggest one, according to this creator in Hangzhou, Ziyang, it's verifying your address, right?
Exactly. Google needs proof you are where you say you are. Security, anti-fraud, taxes, all that. So they physically mail you a letter.
Like snail mail.
Yep. With a unique PI inside. Our source said it took about 1 to 2 weeks to arrive, but the problem isn't really the time it takes.
What is it then?
It's the massive failure rate of international mail at what they call the last mile.
The last mile.
Yeah.
You mean from the local post office to your actual house?
Precisely. That's where things just vanish, get lost, misdirected, whatever. Super common, apparently, especially with international mail going into certain areas.
Okay, so how do you solve that? Just hope for the best.
Well, this is where we get this brilliant little strategy, something you could probably use for anything important coming by mail, not just YouTube stuff. They called it the heartbeat detection technique.
Heartbeat detection. Okay, I'm intrigued. Sounds like something's from TechSport.
Kind of is, yeah. Applied to physical mail. The idea is you need to confirm that the riskiest part of the delivery chain, that last mile, is actually working reliably.
How?
You use predictable, regular mail as your heartbeat. So instead of just crossing your fingers that this one single crucial letter from Google makes it.
The AdSense PIN.
Yeah. This creator picked a verification address linked to a local bank, a bank that mails out a physical credit card bill every single month.
Okay, I see. So if you're getting your bank statement every month, like clockwork.
That's your heartbeat.
Then you know the local postal route works. The mail carrier finds your address. The system is functioning.
Exactly. If that regular local heartbeat mail is getting through consistently, the chance of that one-off important international letter getting lost drops way, way down.
That's really clever, using probability to beat the bureaucracy.
It is. It avoids potentially months of delays, requesting new PINs over and over. Just smart logistics.
It really shows the kind of strategic thinking you need just for the admin side of things.
Yeah.
But speaking of things that can go wrong, the source was really strong on warning people against using proxy addresses. I guess that's tempting, right? Try to use an address somewhere else.
Oh, it's super tempting, but it's a huge risk. If Google systems detect multiple unrelated AdSense accounts using the same overseas proxy address, that's a massive red flag for fraud.
And what happens then?
Usually they lock things down, often permanent account closure. And trying to appeal those decisions, it's notoriously hard, takes forever, rarely works.
So the shortcut could end up costing you everything.
Absolutely. The advice was crystal clear. Use your real, truthful, verified info, always. Dealing with the hassle of verifying your actual address is nothing compared to losing your entire income stream because you tried a sketchy proxy.
Makes sense. And the complications don't stop there, right? Taxes.
Yes, taxes. Because YouTube Google is US-based, but paying people globally, you end up dealing with multiple tax jurisdictions.
So this creator in China had to deal with U.S. taxes.
Yep. First, they had to file the U.S. IRS Form W-8-BEN. This is standard for any non-U.S. person or company earning money from a U.S. source.
Why is that form so important?
Because it declares you're foreign. If you don't file it, the U.S. government automatically makes Google withhold a flat 30% of your U.S. source earnings for taxes.
30%. Ouch.
Big ouch. But by filing the W-8-BEN, you prove you're not a U.S. taxpayer, and you might qualify for a lower withholding rate under tax treaties between the U.S. and your country. For this creator, it got the rate down to 5%.
Okay, so filing that form saved them a lot of money right off the bat.
Definitely. It's basically saying, hey, I'll pay taxes in my own country, don't take the default U.S. chunk.
And they also had to deal with Singapore taxes.
Apparently, yeah. They had to submit some info for Singapore, too. It just shows you the layers involved. Google probably processes some transactions through Singapore.
So you're juggling U.S. rules, Singapore rules, and your own country's tax rules.
All at the same time. Again, the source just hammered home. Use your real info, keep it clean, avoid future headaches and audits. Hashtag TechText2, international payout, and financial results.
Okay, let's follow the actual money. How does it get from Google to the creator in China? The mechanics of the payout.
Right, and things have changed here. Apparently, Google AdSense used to offer Western Union for sending money to China, but they've stopped that.
So what's the standard now?
International wire transfer. The creator used China Merchants Bank, or CMB, said it was pretty simple, just needed the bank card number and the SWIFT code for the bank. That seems to be the way most global platforms pay into China now.
Okay, moment of truth then. The first paycheck. January's earnings, which actually arrived on February 23rd. Let's see the numbers. Because this shows that tax thing we just talked about.
Yep. So the total reported earnings for that first month were $629 USD.
Okay.
And right away, boom, that mandatory 5% US tax withholding kicked in. That was 31 USD.
So the actual amount hitting their account was 598 USD. That 5% is just like a constant fee for playing on the global platform.
Pretty much, yeah. The cost of doing business internationally. But what's really interesting is what the creator did next with that $598.
What do you mean?
Well, most people, they get paid in US dollars. They probably convert it straight to their local currency, RMB in this case, pay some bills.
Right.
This creator didn't do that. They chose financial optimization over just spending it right away.
Oh, so they kept it in US dollars.
Exactly. They held on to the USD and turned it into basically a second income stream. They put it into a USD wealth management product, long say is the term they used, offered by their bank, and they even noted the specific return rate, 4.7% over the last year.
Wow, okay. That's pretty savvy for a content creator just starting out. Why 4.7%? Why keep it in USD?
Well, think about the timing. This was during a period of high U.S. interest rates, right?
Right.
So U.S. dollar yields were often way better than what you could get on deposits in local Chinese banks. By keeping the money in USD and putting it into a product earning 4.7%, they were maximizing the return on those initial earnings.
And avoiding conversion fees too, I guess.
Exactly. Plus, they benefit from the higher yield on the dollar itself. It turns that ad revenue from just a one-time payment into an actual asset that's generating more money. Passive income.
So it's not just income from ads, it's income on the ad income, like a mini investment portfolio starting from the first payout.
It creates this extra layer of financial stability, and it clearly worked because they also shared their February numbers. Views jumped to 188,000, and total earnings went up significantly to $857.
That's a good jump from the first month.
Yeah, about a 40% increase. And they said it was basically down to just grinding it out, making more videos, especially during the Chinese New Year holiday when maybe they had more time.
So smart money management plus consistent hard work. Powerful combo.
Definitely a lesson there for anyone serious about content creation.
Okay, let's shift gears a bit. We've talked about the logistics, getting the money. Now let's talk about the strategy. What kind of content actually makes the money?
Right. And the creator gave us a whole year's worth of data for 2024. You can see the hard numbers, the performance, where the revenue came from, #hey, a year in review, 2024 data. So the big picture for 2024. The channel got 1.5 million views total.
Okay.
Generated 128,000 watch hours. Gained 13,000 new subscribers. And the estimated total revenue from YouTube itself was $7,770 USD.
Okay, $7,770 straight from YouTube. But that's not the whole story, is it? We have to add in that extra income from the USD investment thing.
Exactly. That smart financial move added over $160 in extra passive income. That's more than 1,000 RMB. So when you put the average monthly YouTube earnings together with that investment return,
what does it work out to?
It came out to roughly 4,500 RMB per month in total income, passive or semi-passive.
That's a pretty solid side income. And it really proves the value of not just cashing out the USD right away.
Yeah, treating it as an asset that works for you. It shifts the whole game from just getting paid to actually building wealth. Even on a smaller scale like this, success isn't just the ad check, it's making every dollar work harder. #B, deconstructing revenue streams, the big three.
All right, let's break down that $7,770. Where did it actually come from? There's a clear pecking order, right?
Yeah. Absolutely dominant is stream number 1, viewing page ads. That brought in over $6,700. That's the main engine.
And that includes a couple of things.
Yep. Most of it, $6,400, was from standard ads people see on the videos. But about $207 came from YouTube Premium subscribers.
Ah, right. People forget about that. Even if someone pays YouTube not to see ads, the creator still gets a cut of their subscription fee based on how much they watched.
Exactly. It's like a guaranteed slice, which is nice. But here's the key thing the creator pointed out about this main revenue stream.
What's that?
They have zero control over it. None.
Really? They can't choose where ads go or anything?
Nope. Ad placement, whether it's skippable or not, how often ads appear, it's all totally automated by the YouTube algorithm. The creator's job is just to make stuff people watch. YouTube handles the ad mechanics.
Interesting. Okay, so what's the second biggest stream?
Number 2 is memberships and growth incentives. And this one tells a really interesting story about how platforms like YouTube try to steer creators.
How so?
Well, the creator admitted they didn't even turn on the channel memberships feature because loads of fans were asking for it.
Why then?
They did it purely because they got an email from YouTube in August 2024 with a special offer, an incentive.
Ah, YouTube was basically paying them to try the feature.
Pretty much. And it was a sweet deal. YouTube offered a $1,000 base bonus just for enabling memberships, just turning it on.
$1,000 just to flip a switch.
Yep. Plus, they added an extra $10 for every new member who signed up to a maximum of 100 members, so another potential $1,000 on top.
Wow. So they were basically taking YouTube's money to experiment. Did they get many members?
Only 2, but that still meant they got the $1,000 base bonus plus $20 for the 2 members. So $1,020 total in bonus cash from YouTube.
That's a smart move. Take the platform's money, test the features, see what happens.
Exactly. It wasn't really about building a big membership base long-term for them. It was about capturing that incentive payment.
But is that sustainable, relying on platform bonuses?
Not at all. It's smart to grab the cash when it's offered, for sure. But those bonuses are usually one-offs. YouTube wanted more channels offering membership, so they paid creators to do it. If this creator had banked on that bonus money continuing, they'd have a totally skewed idea of how much their channel actually earns on its own.
Right. It's temporary cash, not core income. Okay, what was the third stream?
Number 3, Super Series, or Super Thanks, was tiny. Just $27 over the whole year.
So that's like tips during live streams or on video?
Exactly. Direct support from viewers. It's not a big earner for most, but it does highlight the platform cut. For these direct payments, Google takes a 30% slice for running the system, processing fees, etc. The creator keeps 70%.
30% cut, okay. And there was one thing they tried and gave up on: affiliate marketing.
Yeah, they dipped their toes in, put some affiliate links in video descriptions, hoping people would click and buy stuff, earning them a commission.
Didn't work out.
Apparently not. They got some clicks, but almost nobody actually bought anything through the links. So they made a pragmatic decision.
Which was?
Basically, the time and mental energy spent finding products, adding links, tracking clicks, it just wasn't worth the tiny return. It took focus away from making the videos, which was generating like 95% of their income.
So they decided to just double down on content creation.
Yep. Focus on what works. Let YouTube handle the main monetization. That decision to not chase every possible dollar, but to focus energy efficiently, that's a key strategic insight too. Hashtag key C. The 3 pillars of content strategy, focusing on viewer needs.
Okay, this next part about how they actually structured their content, I think this is maybe the most critical piece of their strategy. They didn't just randomly make videos.
No, definitely not. It was very intentional. They basically segmented their content into 3 distinct types, each serving a different purpose. And apparently this lines up perfectly with advice YouTube itself gives creators.
Interesting. So what's the first pillar?
Pillar 1, long-tail content. Think of this as the evergreen, useful stuff. Knowledge, experience sharing, how-to guides.
Content that stays relevant for a long time.
Exactly. It provides ongoing utility. The prime example they gave was that video we talked about earlier, the one explaining the AdSense payment process, the address verification, the heartbeat detection trick.
Right, the really practical stuff.
That video solves a specific, persistent problem for a niche audience. And that's where we see the long-tail idea pop up again, but on the content side.
Okay, so how did that one video perform? You said it was a top performer.
The top performer. By a mile. That single video got 170,000 views. It brought in over 7,000 new subscribers. That's more than half the channel's total growth for the whole year.
Wow. From one video.
And it earned over $800 in revenue, just that one video. And the key is that revenue keeps trickling in month after month, long after the initial buzz dies down, because people are still searching for that specific information.
That's the long tail effect in action for a creator.
Yeah.
That one niche, super useful video ends up being worth more over time than maybe several trendy, short-lived videos combined.
Precisely. In a world obsessed with going viral right now, that $800 plus from one evergreen video makes a huge case for focusing on providing real, lasting value. It builds a stable base.
Okay, so long tail utility is pillar 1. What's pillar 2?
Pillar 2, explosive or trending content. This is all about jumping on current events, social hotspots, basically newsjacking.
Trying to catch a wave of traffic.
Exactly. The example given was a video discussing the sudden closure of IBM's China R&D Center. When big news like that breaks, searches spike. Making content around it can bring in a rush of views and new subscribers really quickly.
But the lifespan is short, right?
Very short. Once the news cycle moves on, views for that video will plummet. And the creator made a good point. You can't just chase headlines blindly. You need actual expertise or a unique angle to add value. Otherwise, you just get lost in the noise.
So pillar 1 is stability. Pillar 2 is for bursts of growth. What's the third pillar?
Pillar 3, personal IP or affinity content. This is more about the creator themselves. Vlogs, sharing personal updates, reflections, talking about their journey.
Building a connection with the audience.
Exactly. This is what builds loyalty, what makes people feel like they know the creator. It creates audience stickiness. Maybe these videos don't get as many raw views as the trending ones, but they're crucial for keeping the subscribers you gain. They turn viewers into actual fans who might later support through memberships or super thanks.
Okay, so it's a mix. You need the stable, evergreen stuff for reliable income, pillar 1. You need the trending stuff for quick growth spurts, pillar 2. And you need the personal stuff to keep people around, pillar 3.
It's a balanced portfolio, really, a sophisticated strategy. It avoids the trap of just chasing viral hits all the time, which is exhausting and unreliable. The evergreen content provides that financial safety net. Hashtag tag GMD, revenue per mil, RPM snapshot. Key metrics for creators.
And we can put some hard numbers on which content types are most valuable financially, right? With the RPM figures.
Yep. Revenue per mil, how much money you make for every 1,000 views. And the difference between content types is, frankly, enormous. It's something every creator needs to understand.
Okay, lay it on us. What pays the best?
Long-form video content, standard YouTube videos, that's the king. RPM, there was between $4.63 and $4.76 per 1,000 views.
Almost $5 per 1,000 views.
Live streams were next, a bit lower but still strong. Between $3.18 and $4 RPM. Makes sense. People are usually highly engaged during a live stream, advertisers like that.
Right. But then Shorts, the format YouTube is pushing so hard.
The RPM for Shorts is, well, it's shockingly low. We're talking the $11.13.
50 cents, like 11 to 13 cents per 1,000 views.
Cents, not dollars. Think about that gap. A view on a standard long-form video is worth roughly 35 to 40 times more than a view on a short.
Let me just process that. To make, say, $100 from long-form videos, you need around 20,000 views, give or take.
Right.
To make that same $100 from shorts, maybe 12 cents RPM, you need, what, nearly a million views? 800,000 plus.
Exactly. The math just exposes the reality. Shorts can be great for getting discovered, maybe hitting that 10 million view target for YPP entry if you're lucky, but relying on Shorts monetization for a sustainable income is just not viable for most people.
So the money is still overwhelmingly in the longer form content and live streams.
Absolutely. Shorts are a supplement, maybe a discovery tool, but not the core business model financially.
It all comes back to that strategic thinking, doesn't it? This creator was meticulous, finding the best way to get paid, the best way to invest the earnings, and the most profitable types of content to make.
And that focus, that efficiency, recognizing where the real, maybe less obvious value lies, that idea of the long tail. It's the perfect bridge to our second topic.
Yeah, it really is. We're going from one person optimizing maybe $8,000 a year
to investors managing billions. But the core idea of finding value in the overlooked tail instead of just the obvious head, it's exactly the same principle driving things.
All right, let's make that jump. From the creator's desk in Hangzhou to the global macroeconomics of the semiconductor market. Okay, huge shifts now. We're heading to Taiwan, ground zero for so much global tech manufacturing. We're talking memory chips, semiconductors, and the giant, TSMC.
Right. And the market backdrop, according to the source, is pretty volatile right now, driven by all the AI hype, mostly. The Taiwan index recently shot up near 28,000 points.
Wow.
But they're seeing these big swings within the day, like sharp openings, markets gap up high, but then they sell off and close much lower. And a lot of that pressure comes from selling in the biggest stock, TSMC, Taiwan Semiconductor Manufacturing Company.
And the analysis we looked at was pretty blunt about who actually moves the market, wasn't it?
Yeah, refreshingly so. Said it's not a democracy where everyone's vote counts equally. The market moves based on the collective, but specifically by people with money.
Big institutional players.
Exactly. Their decisions dictate the direction. And because Taiwan's economy is so tightly linked to the global tech supply chain, what happens there is really dependent on outside forces.
Specifically the big U.S. tech names, right? The AI leaders.
Precisely. Investors watching Taiwan have to keep an eye on NVIDIA, NVDA, and AMD. Those are the key indicators. If those U.S. giants stumble, if they have a serious pullback,
then Taiwan struggles.
Taiwan stocks, including TSMC, will likely struggle too. It doesn't matter how well TSMC itself is doing fundamentally in that moment. The fate of the whole Taiwanese market is tied to that American demand for cutting-edge AI chips. Hashtag B. Analyzing TSMC, Taijidian, as an investment.
Okay, let's talk about TSMC specifically. I mean, arguably the single most critical company on the planet right now. They make almost all the advanced chips. How does the analysis view it as an investment?
Well, everyone agrees it's a good company, unquestionably. Its position is almost monopolistic at the high end. They control something like 90% of the world's most advanced chip manufacturing.
Nobody else can really compete at that level.
Not in the near term, no. Everyone needs them for AI, for phones, for high-performance computing. They're essential.
But there's always a but, isn't there? The analysis called the stock slow. Which sounds weird for such a dominant tech leader.
Yeah, it's the TSMC paradox. The stock price has done well, don't get me wrong. It roughly doubled from a low around 780 to maybe 1,500 more recently. But compared to some other AI-related stocks, especially software design companies with fewer physical assets...
It lagged behind.
Yeah. While TSMC doubled, you had other stocks doing 10x, 20x, or even more.
Why is that? Is it just too big, too expensive? Geopolitics?
It's probably a mix of all those. Valuation is part of it. Plus, it's incredibly capital intensive, right? They have to spend billions and billions building new fabs constantly. That weighs on returns. And yeah, the geopolitical risk factor is always there. So while it's dominant and reliable, that very stability makes it seem, well, kind of bullish new. Slow and steady like an ox to traders looking for those explosive quick gains.
Okay, so who should be investing in TSMC then, according to this view?
It's pitched squarely at the long-term investor, someone looking for stability, consistent growth over time. You look at the actual business fundamentals, revenue, profit, earnings per share, EPS. They're all reliably trending upwards.
Solid and predictable.
Exactly. Compared to all the other, 2,000 companies listed in Taiwan, TSMC is seen as solidly middle tier in terms of growth potential versus valuation. Safe, dependable, profitable.
And the advice for buying it reflects that long-term view.
Totally. The analyst basically said, use the dips. When the market pulls back, when TSMC stock drops a bit, that's your opportunity to slowly build a position.
Dollar cost averaging.
Classic dollar cost averaging. Buy small amounts regularly, maybe 5 or 10 shares at a time, especially during weakness. The idea is you get price security over the long run because you're buying into a fundamentally strong company whose earnings keep growing. You're betting on the underlying upward trend, not trying to time the daily noise.
Okay, now let's zoom in on the memory sector, because there's this really interesting split happening that sets up our long-tail discussion perfectly. It's HBM versus the older stuff, right?
Exactly. The market's basically divided in two right now. You've got the hot product, which is high bandwidth memory, or HBM.
That's the stuff needed for the really high-end AI chips.
Yep. Essential for the accelerators from NVIDIA, AMD, etc. It's super dense, super fast, and super expensive. And that's where you've seen these absolutely spectacular gains in related stocks. Like Kioxia in Japan, apparently up nearly 9x. U.S. memory stocks tied to HBM up nearly 10x.
Wow.
That's where all the excitement, all the R&D money, all the new manufacturing capacity is going right now. HBM is the star.
HBM is definitely the head of the demand curve at the moment.
Couldn't put it better. And then, in complete contrast, you have the legacy memory, primarily DDR4.
Which everyone considers kind of outdated. Old news.
Totally. The big memory makers, the 5 majors, they've all shifted their focus. They're pouring resources into HBM and the next standard, DDR5. Production lines for DDR4 are being shut down, converted over. It's seen as yesterday's tech.
So logically, the value of DDR4 should be collapsing, right?
Yeah.
It's being replaced. Why are we even talking about it?
Because the real world isn't just made up of cutting-edge AI data centers. And this is where that long-tail concept comes roaring back, but this time in hardware. #DD. The long-tail effect applied to DDR4.
Okay, remind us again quickly. The long-tail concept. We saw it with the creator's niche video, earning $800. How does it work generally?
So the long tail basically flips the old 80-20 rule on its head. The traditional view is focus on the hits, the blockbusters, the 20% of products that make 80% of the revenue. That's the head.
Right.
The long tail says, wait a minute, if you have a wide enough selection, the combined sales of all those niche, less popular, older items, the long tail of the demand curve can actually add up to more revenue than the few big hits at the head.
Like Amazon selling way more total value in obscure books than just the top 10 bestsellers.
Exactly that. Or Netflix streaming revenue from its huge back catalog versus just the latest blockbuster movie.
Okay. Yeah. So how does that apply to cause a shortage of old DDR4 memory chips? That seems counterintuitive.
It comes down to what actually gets built. Yes, the fancy new AI factories need HBM for the core compute. But building out those massive data centers, it involves tons of other gear, server racks costing millions, and all the supporting infrastructure.
What kind of supporting infrastructure?
Think about basic servers, network switches, storage systems, the internal plumbing of the data center, plus all the other stuff in the world. Enterprise servers that aren't getting upgraded yet, gaming PCs, laptops, even some phones. All that gear globally still needs enormous volumes of
supposedly cold DDR4 memory.
Exactly. The demand for the older standard didn't just evaporate overnight. It's still massive when you add up all those different uses worldwide. That's the long tail of demand for DDR4.
Okay, so the demand is still there in the aggregate, but the big manufacturers stopped making it.
Precisely. They shifted all their capacity to chase the high margins of HBM and DDR5. They effectively killed the supply of new DDR4.
So demand persists, but supply collapses.
And that's the consequence. The existing inventory of DDR4, the stuff already made or the limited capacity remaining, suddenly becomes incredibly valuable. Scarcity drives up the price, even for old tech.
The focus on the shiny new thing inadvertently created a shortage, and thus value, in the old thing.
That's the long tail effect hitting the hardware market. By chasing the premium head, HVM, the industry created an artificial but very real squeeze on the legacy tail, DDR4, and that creates a huge, unexpected profit opportunity.
And the source had actual data on the market impact, right? Prices are going up.
Substantially. The analyst mentioned one supplier was already quoting a 50% price increase for DDR4.
50% for obsolete tech. That's wild.
It is. It completely overrides normal expectations about technology cycles. The scarcity created by the long-tail demand is the dominant factor now. Hashtag tech, hashtag E, trading the memory stocks, Nanya Tech, Winbond, Elite Semiconductor.
Okay, so this fundamental shortage and price hike for DDR4, it's now showing up in the stock charts of specific memory companies in Taiwan.
Directly. It's attracting a lot of trading activity. The analyst made a really strong comparison, saying the technical charts of these memory stocks right now look very similar to how the Sailing Kings, the big shipping stocks, looked about 4 years ago during that huge bubble.
Whoa. So suggesting a similar kind of market frenzy.
That's the implication. A potential multi-bagger setup based on a fundamental industry shift.
What's the specific technical similarity? Is it just price going up?
It's more than that. It's the combination of price, action, and volume. These stocks, names like Nanya Tech, Winbond, Elite Semiconductor, are breaking through major resistance levels on their charts, levels that had capped prices for a long time.
Okay, technical breakouts.
And crucially, these breakouts are happening on huge trading volume. And it's not just one type of trader involved. It's like a perfect storm. You've got short-term momentum guys jumping on the trend.
Yep.
You've got longer-term investors who finally recognize the fundamental story, the DDR4 shortage.
Right, the long tail kicking in.
And you've got swing traders who just love the volatility and are playing the ups and downs.
Yeah.
When all three groups pile in like that, with a real fundamental reason behind it, things can move very fast.
The analyst highlighted one specific stock, Elite Semiconductor.
Yeah, Li Jidian, Elite. Apparently, this was a stock people used to hate, probably lost money on it in previous memory cycles, but then news broke that they were getting big orders, potentially from major clients, and those orders included the anticipated 50% price hikes for DDR4.
And the stock took off.
Saw rapid appreciation. The new reality of the DDR4 shortage completely changed the narrative around the stock, overwhelming its negative history. Money flows to where the scarcity is.
So what's the trading takeaway for these stocks then? Buy the breakout, be careful.
The advice was pretty clear. When you have this alignment of a strong industry trend, DDR4 scarcity, and massive volume confirmation, view any pullbacks or dips not as a reason to panic, but as buying opportunities.
Don't get shaken out by volatility.
Exactly. The analyst specifically mentioned seeing upper shadows on the candlesticks. That means there was selling pressure during the day, pushing the price down from its highs. But they argued that's just temporary noise. The underlying engine persistent long-tail demand for DDR4 meeting near zero new supply is likely to keep driving prices higher overall. It looks like a full-blown trading frenzy based on this overlooked asset.
It's pretty amazing, really. The exact same core idea, the power of aggregated niche demand, explains the success of that creator's $800 utility video and potentially billions of dollars moving in these memory stocks.
It ties it all together beautifully. The creator used the long tail strategically to build stable passive income. The smart investors saw the long tail demand for DDR4 just as the big players were ignoring it, creating this explosive opportunity. In both cases, the big win wasn't necessarily from chasing the obvious hot trend, but from recognizing the enduring value hidden in the overlooked tail. Hashtag tag outro.
Wow. Well, that was quite the journey. A really intellectually satisfying deep dive, I think. We managed to connect the dots from like the tiny details of one creator's payment logistics in China.
Yeah, the AdSense PIN hack.
All the way to these massive global forces shifting billions in the tech supply chain. Two very different paths to success, but rooted in the same basic philosophy.
Absolutely. On that micro level, you had the creators succeeding through sheer meticulousness, right? Getting the admin right, optimizing the taxes, but most importantly, balancing their content. Using that long-tail utility content to build a stable foundation, they didn't just earn money, they made the money work for them.
Optimize it into passive income, yeah. And then on the macro level, you had investors spotting that non-obvious value, the cold stock, the forgotten DDR4 memory.
Yeah.
The big money wasn't just in the crowded, obvious places like shorts or maybe even HBM initially. It was in seeing that huge aggregated global demand for the old stuff that nobody was making anymore.
The core theme just hits you over the head by the end, doesn't it? Whether you're dealing with digital content or physical hardware, your ability to recognize value that isn't obvious, the overlooked asset, the steady passive income, the aggregated niche demand that seems to be the key factor for a real, sustained growth.
It really highlights the need to balance the hot stuff, the trending topics, the cutting-edge HBM chips, with the potentially more valuable cold stuff, the evergreen knowledge, the essential DDR4 components. It definitely makes you think about your own approach.
Exactly. So the final thought for you, the listener, is maybe to reflect on your own strategies, whether it's your time, your money, your business focus. Where are you maybe too caught up in chasing the visible, volatile head that everyone else is fighting over?
And what powerful, persistent tail? What overlooked demand? What undervalued asset? What source of stable utility might you be missing right now in your own portfolio or strategy?
Recognizing that hidden value, that seems to be the real takeaway from today's deep dive.
Couldn't agree more. Well, thank you for joining us for this exploration of the dual economics of creation and chips. We'll see you next time on The Deep Dive.